last week we were discussing non-fungible tokens or NFTs. In early 2021, there has been a big hype about the NFTs, in which like people are buying digital artworks, digital contents, and even a home certificate as an NFT through the blockchain. Actually, NFTs are just one of the applications of what we call the decentralized finance or DeFi. Decentralized finance actually refers to financial activities that is conducted through the blockchain using cryptocurrency without the help of any intermediaries such as banks, governments, or fintech softwares. So now, for a lot of people, it might be confusing on how come like a financial transaction be conducted without those intermediaries. So, explore the issue, this morning, I'm your host Sebastian Partogi, and I'm gonna talk to the Blockchain 2 CEO Roberto Capodieci to discuss decentralized finance. So, hi Roberto.
Hello, thank you for having me here. And I want to a little bit disagree that NFTs are part of DeFi. In fact, I see NFT as the first step outside finance when it comes to blockchain adoption for decentralized transactions. So having a title that represents a piece of art, yes, can be sold and purchased, which is a financial thing, but the fact they exist as a title in the blockchain is not really straight financial thing. So the power of having NFTs, I think, really just to bring the adoption of blockchain outside finance. So it's a very important step in my opinion.
Yeah, like because NFTs are actually the certificates, a certificate of ownership, yeah, like to certain properties, so not necessarily when you buy an NFT, not you don't necessarily own the properties or the objects.
Yeah, no, I mean, NFT is just an object that lives in the blockchain. In fact, in our own platform, we don't call NFT, we call it blockchain object. So it's not an account of a user that is the person behind, is an object that lives in the blockchain, can change owner, can have a set of parameters or, like a lot of information attached to it, can be audited. Maybe people can see how the ownership change in time and so on and so forth. So the NFT is new, exists a long time, it's just being discovered now by the general public. It's a new form of item that can live in the blockchain, right? From what was a token that is equivalent to a coin, so it goes by quantity, where one token is identical to the other. So like coins in the real world, if I have a €1 coin, you have a €1 coin, we can exchange, we both remain with €1. There is nothing different from one to the other. While with NFTs, being the NFT a unique piece with this unique history, with a unique set of data, once I give to somebody else, I don't have it anymore, and this person has it. So they can be used to represent the ownership of a physical object. It's called digital twin. So it represents the settings of a machine. It can represent many other things, and people can trade them and also sell and buy them, which is something related to finance. But on the topic of today of decentralized finance, I think the NFT are on the suburbs of the decentralized finance world.
Okay, so I wanna ask you, like, how does blockchain give rise to the decentralized finance?
Yeah, so the decentralized finance is an interesting evolution of the use of smart contracts in a blockchain like Ethereum. So a smart contract is logic set on the blockchain that can be executed like a small software application, right? And nothing complex. This logic allows to do particular things. For example, creating tokens. There is a logic, a small database that says there is this amount of tokens, and the database lists the account that owns the tokens, and there can be certain rules for trading. For example, can trade until a certain date, can only trade in block of such, blah blah blah. Evolving this logic, people start implementing equivalent systems to what the classic finance is offering. For example, there is the possibility to loan some cryptocurrency into the system so that people that want to borrow the cryptocurrency can leave like 150% of another asset that is also digital in the blockchain, and when he returns the loan with the interest that he has to pay, that he can claim back his asset. If not, his asset are exchanged in the market and nobody loses except the person that didn't manage to pay back the loan. It is an interesting process. Let's say I have a lot of certain cryptocurrency that I don't want to give away because I think it's gonna go up in price, but at the same time I need to have some euros to buy a car, and I want to buy an installment because with my salary and all I can afford to do installment without touching my capital. So in this way I can deposit my cryptocurrency in a DeFi contract. This DeFi contract release what is called a stable coin representing euro to me. I go to an exchange, I withdraw the euro, and I go to the car dealer and I purchase the car, unless the car dealer can accept the crypto stable coin directly, so I can just pass the money for the car directly to the car dealer. At this point, I am asked every month to make a payment until the payment is fully done with the correct interest amount, and my capital that I've left there I can get it back, or I can leave it there for somebody else to make loans and pay back. So in this way we have removed, because the logic is quite simple and straightforward, we have removed the need of all the bank that makes money in the between, which here the money are distributed to the system leaving liquidity. Let's say I want to borrow stablecoin euro, there is need of liquidity, so somebody is going to put the stablecoin euro available so people can make the loan, leaving Bitcoin, for example, inside. And to do this, they also make money. So somebody that has money can leave there available as liquidity and earn a part of the interest the DeFi contract is allowing. So from this, there is quite simple and straightforward. Two more complex systems. One of the beautiful things that the DeFi has done at the beginning is the creation of this stable coin. A stable coin is a representation in cryptographic token of real life fiat currency. So because the world still work around fiat currency, the world still work around dollars or euros or whatever else, there is the need to be able to have a counter value in euro or dollar. Because the cryptocurrency market also live with exchanges, so we can say Bitcoin went up, is worth many more dollars now than it was worth before. There are some bucket of cryptocurrency, non-cryptocurrency, let's say Ethereum, Bitcoin, etc., they will represent 150% in average of the value of euro or dollars. The blockchain can use is called Oracle, so they can take some information from outside the blockchain itself. For example, which is the value today of Ethereum against dollar or Bitcoin against dollar, and based on that, know how many mintable, how many creatable euros or dollars stable coin can do. Once these coins are out, the counter value in crypto is the guarantee for this coin. If the counter value goes below, let's say 120%, somebody can either return or is gonna lose the counter value. So in this way, so either return the capital and cash out the crypto, or he's gonna lose the crypto because it's gonna be liquidated automatically, put for sale automatically, in order to gain the euro that or the dollar that it was guaranteed. So there is never a situation where people has a euro that are not covered by an equivalent cryptocurrency. The beauty of all this is that it's all decentralized. So these are rules pre-written in smart contract, deployed on the blockchain, and they live their own life. There are some places where still there is not a fully decentralized bridge between parts. For example, to have many different cryptocurrency as counter value for something, there is no one blockchain that can hold them all. So people need to live in the end of somebody the guarantee of some crypto that this person has the key for, in order to say they're being wrapped around a token, and there is an equivalent token that represents the Bitcoin. So if I have actual Bitcoin and I deposit them to an account, then the equivalent amount of token, they're called wrapped Bitcoin, that will be created in Ethereum. So this is often done off-chain by some private company that guarantee this. But slowly we're gonna end up to have 100% of decentralized functioning for decentralized finance.
Yeah, and in the smart contracts, who actually write the rules for the transactions?
Okay, well, this is a good question. So there are many developers that create smart contract. Many times, many smart contracts combined together create a DeFi product. So it's not just one person that code the whole thing. There are other cases where one single person coded the whole thing. There are many interesting systems to create stable coin, many interesting systems to create microloans system. Many people see the code made by other and copy and change it and paste it, and release a new DeFi fantastic token where everybody wants to put their money. This obviously leads to some security issue, because you will never know what the code does unless you're a developer that can really look at the code. To access the application, there is a UI that you need to access and trust that is actually acting the correct way with the correct smart contract. There is still a lot of bridges that need to be crossed, and we need to trust that the bridge doesn't collapse under our own feet in order to guarantee the functionality of this. So there is a lot is very much prone to fraud. This is in the technical aspect. So people creating a front end that tells you that is dealing with this contract, but is actually dealing with another contract. Another deploy a contract that looks 99.9% like a legitimate contract, but there is one line of code that allows this person to steal the funds. And because it's decentralized, it's anonymous, nobody knows who is the author of these things. Some people certify the contract, so send this contract to be verified by some supposedly super geniuses developer company that can give you a certification that everything is good, but how can you determine that this is true? Is actually just a small image on the website and the possibility to go to the link of this company says, yeah, this contract is correct. And again, who does this check before doing all these frantic DeFi operation that are on the rush? So there is a lot of space for fraud.
Yeah, and then I've been watching lots of French detective series, and then I don't know, like whenever they portray like a criminal, like a drug dealer or organ trafficker, they always, the storyline always has it that these criminals conduct their transactions using Bitcoin. Yeah. Is the cryptocurrency actually a hub for illegal activities?
But now this is like anything, right? So before crypto existed, there was no crypto, but the criminality still existed, right? So they would operate with other things. I would say that the biggest money laundering operation, the biggest financing for a criminal organization, they still happen through trade finance operation, through classical banks, and is well known. It's not very much publicized when it happened, but we know the fine, the multi-billion-dollar fine that many banks are subject to pay. Through this, it's much easier to track cryptocurrency transaction than it is easy to track where funds goes through a strange bank operation or handling of cash or other things. Obviously, when there is a new tool available in the market, also the organized crime is gonna, partake in the adoption of the new technology. But it's not because there is anything special in this cryptocurrency that make it particularly convenient. In fact, it's actually not so convenient to use cryptocurrency to do crimes, because the traceability of them. Just thinking that specialized investigator from FBI that arrested the guy, the organizer, underground market called the Silk Road at the time. Two of those FBI agents that were specialized in cryptocurrency and blockchain decided to steal part of the Bitcoin of this guy. They were cut immediately. So even though even then they thought they knew how to hide the tracks, they actually couldn't hide the tracks. It is very complex to deal with the dirty cryptocurrency compared than dirty cash. So the laundering of fiat currency is way easier than laundering cryptocurrency. So I would say that criminals use it in the illiteracy, in the ignorance of what cryptocurrency is, just because it's easy to keep it anonymous, I would say. But cash is anonymous. Cash needs to meet people person in person. Cryptocurrency you can transfer from one side to the other of the planet with no problem, and this makes it easier as a tool to pay somebody remotely or without meeting in person. But as soon as a payment is connected to the crime, those money are worth nothing. So actually it's easier, because when you break into a drug dealer house and they find a lot of cash, they automatically, law enforcement, connect the cash to the illegal operation of selling drugs. Maybe it was grandfather's savings, you never know, while with cryptocurrency you can perfectly know the amounts and the origin and everything of the cash you find. So if this criminal had a legitimate cryptocurrency of his family and the part are part of the crime, the law enforcement knows exactly which part are originated from illegal activity and which part are legitimate, for example. Difference from the cash that is already mixed. Once you find cash, it's hard to say what to come from where, right? So cryptocurrency for crime, not the best choice in my opinion.
Okay. And then traceability is an important aspect here, because I think when we were discussing supply chain 2 weeks ago, I know lots of companies, especially retailers in the US, are now implementing blockchain for their first food system, and also logistics, but also in the blockchain transactions, it's more traceable than decentralized transactions. So what is it about the decentralized system that make it traceable?
Well, any system has logic to be coded and programmed in the way that is needed, right? The power of a decentralized system like blockchain is that there is no central authority to handle the data, right? So you don't have one data center with one IT person that can be bribed to modify the data. So the data resides in many different nodes, handled by many different people that have no interest to conspire together, and in this way the data is safe. So if somebody tries to modify, it's easily cut in the act of tampering with one single node. So it's part of the mechanics that the node that there is no equal to the majority is automatically out of the game. Obviously the system has to be coded properly, and the mechanics have to be coded in such a way that cannot be gamed. But this is the logic. This goes also with DeFi, because the vulnerability are of two kinds. One is technical, in the terms of the code is not done properly and there is a logic, let's say, mistake in the code. One classic system to do crowdfunding that was deployed at the beginning was called DAO, like a decentralized autonomous organization, meaning there's a business that has no controller but people use it. The developer made the mistake of processing reimbursement of money in a way that first the money are reimbursed and then the balance is reduced in the database, and somebody found a system to restart the operation after the money are sent, so you can get reimbursed without the balance decreasing for the reimbursement. This is a coding mistake that led to a vulnerability and led from people to steal millions of dollars out of it. Another is a logic mistake. For example, in some DeFi contracts that were coming out at the beginning, you can put any token as a counter value to take a loan and creating a new token. So people were actually making the token, using to create the loan and take this token that has a value, mix it together with new token, and do this in a loop for which they were taking loans that were never being covered by the counter value of a crypto that didn't have any value, because it was tricking the logic of the system to consider the looping item every time valuable was always the same value repeated many times. So people start tricking this contract and stealing all the liquidity put there by people that were thinking to make some money where they lost everything. So I think there are a lot of steps to do to make the system valid, secure, easy to use, with the guarantee that what we're using is the right thing. But there are fake banking, mobile banking application as well, where people download mistakenly from not the developer from the bank, but the fake developer, and get all their funds in their bank stolen. This happen anywhere. It doesn't happen only with DeFi, right? So it is an issue that that time is gonna fix, I think.
Okay. And okay, so how does decentralized finance differ from the conventional one?
So what I would say that decentralized finance has very precise written rules, and once it's deployed with the rules don't change. So there is no human factor in the middle. So you don't have a human making a mistake, a human helping a friend and blocking somebody else. So an application doesn't look at the skin color of people, doesn't look at race, doesn't look at anything, so cannot discriminate. Whoever wants can apply. I was reading this very interesting tweet from somebody that says, it's not the Lambo tweet, not the Lambo story, meaning that there is this myth from people that invest in cryptocurrency, they're gonna buy a Lamborghini and be making so much money with cryptocurrency. Many people did. But says, I bought a family car using DeFi, left a counter value of crypto, made the loan, went to the dealer and bought the car. And I said, the fact that I didn't have to sign tens of things, feeling judged by the person in the bank that is gonna decide to give me the loan or not, etc., is priceless. Besides, the interest rate paid is much lower than the one that the bank is asking, simply because the blockchain doesn't have employee buildings and stuff to pay, so can live with a much lower interest rate. And this is the true. At the end, what is more convenient to the final user is the ease to access this sort of things. Obviously, if you want a loan and you have nothing to give as guarantee, the bank may give you a loan anyway in the fate of your project. But the contract of DeFi that there are now, not. They only want to see a counter value that is good enough to guarantee the loan. But I would say that as soon as the accessibility to this kind of functionality are good and easy enough and secure that my mom can access them, at this point it wins. Is the disruption that Uber brings to taxi driver, that Airbnb brings to room rentals, that all these middlemen like brokers online that don't produce content but sell content made by other people, etc., bring in the market. DeFi is gonna clearly create a big issue for banks, for financial institutions, and making it illegal is gonna just advertising it more. So there must be some good approach from regulator. I think if they were worried for cryptocurrency, there was no worry. Cryptocurrency is an alternative of fiat currency. But decentralized finance, that's really the alternative of the bank. That's something that banks should be very concerned about, I think.
Okay. And what are the current applications of this decentralized finance?
But there has been a lot of attempt to make a fantastic application. Unfortunately, the main blockchain that supports smart contracts is Ethereum, and he ended up to have fees so high because it's not scalable that to make a micro loan to borrow $50, it costs you $120 to sign in the application, which doesn't make sense, right? Even simple alternative currency built on Ethereum, for example, USDT, USDC, which are ERC20, let's say, that represent US dollars, it became cheaper to transfer them via regular bank than transfer them via Ethereum, because transaction reached $10, which is a lot of money, let's say, compared to, to send $5, it cost me $10, doesn't make sense. So this brought the usage of this DeFi only for large capital. So when you have $50,000, $100,000, then a fee of 100 is relatively heavy. But it also gives birth to a lot of alternative blockchain, alternative network where these things are deployed. Copy and paste. People clone Ethereum, there is no traffic, and in their blockchain, the smart contract not cost $120, but cost like 5 cents to publish. And with other technology, there is a layer 2 solution, so off-chain transactions that are guaranteed by the blockchain, where the cost is only entering in, but then all the transactions inside are very cheap. And this is in fact what is getting adopted the most. And is now, even for NFTs, let's say NFTs where transacting one NFT costs $100, you can do it only for art piece that costs several $1,000, because a smaller piece that costs $50, you cannot pay more just to transfer it to somebody else than the value of it. While the same NFT in a second layer solution like Matic, for example, you deploy with 50 cents, you transfer with 0.005 cents, so it becomes super affordable. For now, maybe tomorrow this is gonna change as well, so it's all to be seen.
Okay, and what are the current weaknesses of the decentralized finance system? You already mentioned some.
I think the fact that it's very hard for the common person, for the average Joe, to validate the quality of a contract. So the smart contract that is used for the operation that somebody do is really a blind thing when people click, because going to identify the correct contract that is called by the web application means already decoding all the web application, understanding what happened behind, because you cannot trust what they write on the screen, And then once you identify which is the smart contract really called, go analyze the code of the smart contract, make sure that doesn't do anything wrong. If people pay $50,000, $100,000 to have a smart contract validated by a company that for some reason has the authority to say that the code is right, means that you will be valuable $50,000, $70,000 if you have the ability to do the validation by yourself, which means there is a rarity. Even the developer and develop the contract themselves are valued like this. So this means that it's impossible for the average Joe to use DeFi having 100% guarantee that this is working exactly. The only thing is the reputation. You saw that many people did it, it went right for them, and you do it. But if you think to Arthur Ponzi with this Ponzi scheme, a lot of people made money before people lost money, right? So I'm not saying that there is a Ponzi scheme in DeFi, absolutely not. I'm saying just that sometimes things work for a while and then collapse for many reasons. So I think it's good for now is the pioneers are rewarded well, because they do this jump in the dark and trust this new contract, and in this space there is still need a lot to grow. It's gonna be interesting to see regulator what they say, but I think they're thinking very well what to say, because after the approach on cryptocurrency failed in many aspects until they were forced to adopt it, now with DeFi it's gonna be interesting to see, because you cannot forbid me to put logic on how I move the crypto they already authorized, right?
Okay. And what about the security of the system?
The security of the system is, when it comes to blockchain, the blockchain is safe, right? In general terms, and again, some clones they use systems that are not secure, like proof of work, they can be attacked as well. Means I can attack a proof of work clone of Ethereum that doesn't have a lot of hashing power. I deposit a lot of counter value, and then I withdraw a liquidity of some other kind. Let's say I put 100 Bitcoin, I take the equivalent of US dollars, I change this in exchange with something else, then I attack the blockchain with a lot of hashing power. I remove my transaction where I deposited things in the DeFi contract, and I stole liquidity from the DeFi contract. This is not because the DeFi is not coded properly, but because the blockchain allowed to do this if it's not a strong blockchain. There are other security issues, but are all related to the infrastructure, let's say. So if the smart contract is coded properly and people can evaluate, the whole system is secure. Like if logic and code are strong and the blockchain where it runs is strong, there is no reason to think security. Security comes in the interaction with the smart contract. They need to be trusted.
Okay. And what will be the future uses of the decentralized finance? So how will it revolutionize the financial world or sector?
Well, I think banks need to reinvent a little bit how they operate and adapt themselves to this change. I think the most intelligent thing for them is to adopt the technology that is there and offer them as side by side the service with the service that they already offer, and then give a sort of guarantee. People goes by reputation. If my mom deal with the same bank for 50 years and trust them, she would trust them, doesn't matter, rather than an anonymous define things. New generation that are more against the system will be tricked into using this decentralized finance, which is actually operated by the bank, and that makes the interest and provide the liquidity. So I think that as banks start closing the in-person office and go online to be more mobile application only to reduce cost and be able to reach clients that act differently from the old client that want to be there in person, I think in the same way they should start adopting decentralized finance and offer this directly from their mobile application. For example, they're gonna make money too because they have the liquidity, and there is no silly tricks to be played because cryptocurrency is accounted for, so people cannot loan money that they don't have, like we know financial sector did in the past. I think that the fact that the money are smart means also that, and this is like suburbia for DeFi, but I can give my daughter some money to bring school, and she can use only to buy lunch. She cannot use the same money to buy something else, right? So this allows to categorize money, the spendability in a wallet in a way that is more smart. So you can use only this money only to pay at this shop and not in another shop. So there is no the bullying of stealing, the cash from between kids. There are a lot of other things, for example, in how to guarantee retirement funds when people is employed in a company. I can deposit crypto that has a certain logic. For example, if people resign, they lose certain things, but it's all mechanically reason in terms of how the functioning of this goes. A lot of people is mixing artificial intelligence, and I quote artificial intelligence because it doesn't exist in my opinion, but there is machine learning or particular algorithm to combine mechanics on the blockchain with the data collected from real life. There is all the integration with IoT devices, so only when you're using the car then those funds are paying the insurance, blah, blah, blah. So there are a lot of interesting things that can be done.
Yeah, and finally, if someone is interested to start perhaps like investing, in a crypto market or wanna buy something through the what are the basics that they should learn?
well, I'm not a financial advisor, so I'm not legally authorized to give any financial advice, nor I can give because I'm not an expert in this. I would say to pay attention. So everything related to the crypto world is like casino. You go in with the money that you know you can lose. You play with them, you lost them, don't cry, but never put money you don't have or money that you are not ready to lose. If things goes well, good. If things goes bad, don't have regrets. So this is, to me, the safest approach to anybody that want to enter this a little bit unknown markets and currencies, because there is nobody that gonna protect you. Regulators, in theory, are there, and in many countries are for real there to protect consumer. In many countries, regulators are seen as enemy of the consumer, right, to protect the banks. But in theory, the work of the regulator is to make sure that financial institutions don't take advantage of the consumer. When it comes to decentralized finance, there is not much regulators can do because there is hard to connect one person to one, decentralized application, smart contract.
Okay, so thank you very much, and thank you for tuning in to our discussion today about decentralized finance. If you still have any questions or you'd like to suggest like a topic which we should explore in our next episodes, do leave your comment in our website or in the comment section of the YouTube video below. And don't forget to subscribe to our YouTube channel, Blockchain Zoo. I'm your host, Bastian Partogi, and I'll see you next time.